Crypto traders may have major tax concerns because of the dramatic increase and fall of some cryptocurrencies, such as Bitcoin and Ethereum. The Internal Revenue Service, or IRS, is ratcheting up enforcement efforts, and even individuals who own the currency, let alone trade it, must be careful not to break the law. Given how the IRS views cryptocurrency, this may be easier than you think. Hey everyone, welcome to Crypto Trends. In today's video, we will take a look at 8 important things to know about crypto taxes. So, make sure to subscribe to the channel so you don't miss out on any of our videos. So, without further ado, let's get into it. Number 1. You'll be asked whether you owned or used cryptocurrency. Form 1040 asks, in a prominent location at the top, at any time did you receive, sell, send, exchange, or otherwise acquire any financial interest in any virtual currency? So, you're on the hook to answer definitively whether you've transacted in cryptocurrencies, perhaps placing you in a position to lie to the IRS. If you do not answer truthfully, you may face additional legal consequences, and the IRS does not look lightly on liars and tax cheats. There is, however, a footnote. The IRS clarified that taxpayers who solely purchased virtual currency with actual money were not required to answer yes to the question. Number 2. You don't escape being taxed just because you didn't get a 1099. A bank or brokerage will issue you, and the IRS, a Form 1099 including information about your annual revenue. Cryptocurrency may be unique. Bitcoin does not have the same level of reporting as equities, interest, and other payments. Coinbase and other exchanges fail to produce accurate IRS data. A law passed in November 2021 will require more tax reporting from the industry beginning in 2023. Brokers must report their transactions to the IRS on a 1099 or equivalent form under the legislation. Opponents argue that the measure would force anyone who trades cryptocurrencies, including miners and crypto wallets, to adhere to new rules. Legislators are working on a bill to narrow the reach of the statute. Even if you don't get a 1099, you must report and pay taxes on your gains. Capital losses can be deducted on your tax return to reduce your taxable income. Number 3. Just using crypto exposes you to potential tax liability. When you trade virtual currency for real money, products, or services, you may incur tax responsibility. If the price you receive for your cryptocurrency, the value of the good or actual currency you receive, is greater than your cost basis in the cryptocurrency, you will incur a debt. So, if you receive more value than you paid into the coin, you have a tax burden. Of course, you could have a tax loss if the value of products, services, or actual currency is less than your Bitcoin cost basis. To make the computation in any instance, you'll need to know your cost basis. It should be noted that this is not a transaction tax. It is a capital gains tax, which means it is levied on the recognized change in value of the coin. And, just like a stock, if you don't trade the cryptocurrency for something else, you haven't made a gain or a loss. Number 4. Gains on crypto trading are treated like regular capital gains. So you made a profit on a profitable transaction or purchase. The IRS normally treats crypto gains the same way it considers any other type of financial gain. That is, for assets held less than a year, you will pay conventional tax rates on short-term capital gains, up to 37% in 2022, depending on your income. Long-term capital gains tax, likely at a lower rate, will apply to assets held for more than a year, 0, 15, and 20%. The same rules apply to cryptocurrencies for netting capital gains and losses against each other. As a result, you can deduct capital losses and generate a net loss of up to $3,000 every year. If your net losses surpass this level, you must carry them over to the following year. Number 5. Crypto miners may be treated differently from others. Do you mine cryptocurrencies for a living? Then you may be able to deduct your expenses in the same way that a conventional firm would. Your income is the monetary value of your output. If you mine cryptocurrency, you realize income at the fair market value, so that's your basis in the cryptocurrency. If this is a trade or business, your expenses may be deductible. But here's the kicker. You have to be in the trades or manage a business to qualify. You cannot operate your mining rig as a hobby and claim the same tax benefits as a legitimate business. Number 6. A gift of crypto is treated the same as other gifts. If you gave crypto to someone, say a younger relative, to pique their interest, your present will be treated the same as any other such gift. If it exceeds $16,000, it may be liable to the gift tax. If the recipient decides to sell the present, the cost basis stays the same as the giver's cost basis. However, even if you exceed the annual level, there are certain ways to prevent the gift tax, such as using the lifetime exemption. Number 7. Inherited cryptocurrency is treated like other inherited assets. Cryptocurrency that has been inherited is handled in the same manner as any other form of capital asset that is passed down from one generation to the next. They could be required to pay estate taxes if the value of their estate is greater than the threshold set by the government, $12.06 million. Like stock, cryptocurrency enjoys a stepped-up cost basis to the fair value on the day of death. So, generally, cryptocurrency is treated for most people like a typical capital asset. Number 8. The wash sale rule does not apply to cryptocurrency. While the IRS generally sees cryptocurrency as capital assets, it takes a whole different stance when it comes to wash sales. This is actually advantageous for cryptocurrency traders. When a trader sells an asset and declares a loss, the trader must not have purchased the asset, or one extremely similar to it, within 30 days of the sale. If the trader repurchases the asset within that 30-day period, the transaction is considered a wash sell. As a result, the loss cannot be claimed as a write-off unless the trader refrains from purchasing the asset for at least 30 days. However, the wash sale rule does not apply to cryptocurrency. So traders can sell their position, book a loss, and then repurchase the asset minutes later while still claiming the loss. That rule is advantageous because it allows traders to collect the full value of the tax loss while still investing, effectively implying that taking advantage of the tax write-off is risk-free. However, legislators have been contemplating removing this loophole, so it may not be around for long. So, what are your thoughts on cryptocurrency taxes? Also, do you think the wash sale rule should be applied to cryptocurrencies? Let us know in the comment section down below. With that being said, here we come to the end of our video. I hope you liked this video. If so, then don't forget to subscribe to the channel so you never miss any video. See you in the next video. Till then, take care. Thanks for watching.